It's been an interesting week on a number of fronts for financial markets. We've had the revised Greek budget. We have the run-in to the US election for next week, and we've had a raft of corporate and economic data that has been coming out this week. Some mixed, and so we'll be looking at some charts and mixed reactions to those events. Let's have a look at, first of all, Greece. Greece has actually had a pretty tough week on its stock markets, albeit that, to put it in some context, the Greek stock market has doubled from the low of June. It was trading around 450 and peaked out at 900, but around about 13% lower. And during the course of the week, I do think, whilst this is a very small market, it does need deep watching, because the Greek budget was published this week, and again they've managed to surprise on the downside. Net debt to GDP is going to come in at 189%. The economy is going to decline by a further 4.5%. That's the 6th year in a row, and the combination of this means that the chances of them getting to 120% net to debt to GDP by 2020 look increasingly unlikely. So the conversations around and about are, will that timetable be extended by another couple of years? And so we pushed it out to 2022. But I think where the situation will evolve, and could evolve very, very shortly, is relating to the vote and the imposition of some of the more extreme measures of austerity, which clearly at the moment are just meaning that it's becoming increasingly difficult for them to meet their expectations. And then what happens? Do they put the money in? Do we come back for more money on the table? Do we look for some debt forgiveness? So I think the Greece issue will come back to the fore at some point in the not too distant future. In terms of the US this week has had some quite important data. Indeed, we filmed this just prior to the publication of the non-farm payroll data, which for the forecast is in for another rise of 125,000. President Obama will be generally pleased with the quality of the data that's been coming out prior to the election for next week. Overall, it's been consistently sort of in line with forecasts. There is one chart I did want to share which came from Goldman Sachs. Goldman Sachs have what we refer to as an activity index. So they try and replicate what is known as the ISM survey by speaking directly to the corporate executives and ask them how they are feeling. So we can see by this chart that over the period of 2005 to 7, it has a fair degree of consistency about it. But just look how it's starting to diverge in the course of the last few months. The Goldman Sachs index really sort of moving down to post-recession lows, whilst the ISM survey is moving up. Now, ISM did publish this week. It came in, it was in line, it was up at 51. There was some speculation, particularly from Goldman's, that they may have seen a poorer number. But I'm going to certainly keep this chart in mind for subsequent ISM numbers, because if it is ISM that is in fact misleading on this, then we could be looking at some poorer numbers ahead post the election. Turning to some corporate results for this week, I think that we've had a raft of results out from the banks, and then generally this is a sector that, whilst it's constantly criticised for its losses, of course, but the share prices are indeed performing quite well from the start of this year. Indeed, it's been one of the best performing, if not the best performing sector of this calendar year, and they continue to see share price increases despite the fact that we're seeing more provisioning coming out, particularly for PPI insurance. All three of the banks this week have been publishing further provisions for PPI. It's taken the total to around 12 billion now for the cover, making it one of the biggest mis-selling scandals of all time. It's up there with the pensions selling. Indeed, we understand that around 34 billion has actually been issued in premiums over the course of the last 7 years. So the more claims that come in, these provisions could continue to rise. But the good news for the banks is that their core businesses are making good money. Indeed, just quoted RBS as an example, the underlying profitability was around 1.2 billion in the last 3 months. So they're making the cash on the core businesses, but they are certainly writing all of that off and continuing to sort of try and clean up the balance sheet. But markets seem to be, as evidenced by the RBS chart here, this is a year-to-date chart. You can see it's really just sort of breaking out down to new highs. We've got Barclays just underperforming a little bit here, but nevertheless at the top end of the range. Probably Lloyds is the star performer. This is definitely the most operationally geared towards improvement within the UK economy, improvement within credit impairments, because it has mopped up such large market share during the downtime by taking on HBOS, and obviously that includes the Halifax Building Society. One other sector that worthy of feature is the energy sector. We had a very surprising profit warning out from BG Group this week. The expectation for production growth out of BG has been 6 to 8% year after year, but they've suddenly revised that to 3% for this year and 0% for next year. Cumulatively, that means there's a 10%, maybe even 15% cut to production for 2013. Now, the feeling around is that this will prove to be a short-term aberration to their growth story, and that growth will resume in 2013, 2014, but you can see the marked impression that had on the share price this week, so it took a lot of premium out of the stock. We did see some interest coming in on the back of that, and there is a revised note available if you speak to your broker. But on slightly better fortune, BP and Shell both reported this week. I will highlight BP as saying that the one feature for me was that their dividend growth was higher than anticipated. If you annualise that dividend growth, you're looking at around a 5% annualised yield, which is about the same as Shell, but you can expect the dividend growth to be higher out of BP, slightly compensating for the additional risks of where they make their money, but nevertheless it does feel to me like BP is slowly working through its problems and its shares beginning to move to the upside.